Hi, everybody, and welcome back to the Wealth Clock podcast with Stephen Weinstock. I've been investing in real estate for over 20 years, single family, multifamily. I now have a real estate investment fund that I call the Goethals Capital Fund. I purchase properties in cash. I eliminate the mortgage risk. And after a year, I refinance in order to scale and buy more properties in cash so I can get a tremendous discount. Today, I am excited to have Andrew Freed. Thank you for visiting, Andrew.
Of
And
course.
Andrew is known as the Multifamily Guy and Investor Freed. He started his career as a W-2 project manager, but after he read a book, I guess it was called Rich Dad, Poor Dad. I never heard of that book, but okay. I'm joking. I've read it. Just about every real estate guy puts it in their top 5. You pulled the line of credit on a condo that you owned in Boston, and you used it to buy your first deal. I'll ask you about that. And within a few years, you scaled to 400 rental units while still working a full-time job. Did I get that right?
Yeah, I quit my full-time job about a year ago at this point.
Okay. Today you own Freedom Management. I like how you use the word freedom. Again, your last name is Freed. And you've syndicated to larger properties, including a larger 65-unit deal in New Bedford. You've been featured on Bigger Pockets. Okay. The Best Ever Show. Great podcast. Dozens of other podcasts. And now you are on my podcast. Thank you very much. I really appreciate it. Andrew, welcome to the show.
I am extremely honored to be here. You are a wealth of knowledge, Steve. I'm going to learn just as much as your listeners.
Okay. We're 30 seconds in and you're already giving me compliments. But no, we had some conversations off screen, and Andrew was kind enough to allow me to rant to him. Andrew, tell me where you're from first.
So I am from a little suburb outside of Boston called Randolph, Massachusetts, 20 minutes south of Boston.
Got it. Okay. So you're in the Northeast. Boston is definitely a high real estate value area. I'm assuming the suburbs are also as well.
Absolutely. Definitely.
Okay. So tell me, you're working a job. What kind of job did you have at the time?
So I was a project manager. I was actually specifically a grant manager, and I helped researchers get funding from federal sponsors.
Oh, wow. Okay. But this is a desk job, correct?
It was a desk job. I was more or less a project manager, doing paperwork, submitting applications, doing budgets, making sure the finances are on track. But more or less, it was very much a desk job. Yes.
Okay. You want to get into real estate at this point. How'd you get into real estate?
I was really sold this false narrative growing up that if I get a bachelor's, if I get a master's, if I get a good job, a nice 6-figure salary, a swanky condo in the city, like I made it, right? Like I literally did it step by step, right? And I got to the end result. I worked at the Broad Institute of MIT and Harvard, prestigious organization. I was making, I believe, $125,000 at that point. Like I essentially made it. I had a condo in the city, right? But when I came home, I really felt empty. I really felt like I was locked in a prison. Like every single day I had to go to this job. I had no control over my time. And I really wanted to find a way out. And it was right during COVID. And thankfully, I don't know who gave me this book, but whoever it is, I owe them my life. They gave me Rich Dad, Poor Dad. And when I read this book, it literally opened it was like a hidden language that I realized that literally I learned everything wrong about money. And this is everything right about money. And there were little inklings of real estate. So at that point, I was like looking at my net worth, which is about $250,000. $200,000 came from this one bedroom condo I completely forgot about. It literally took me 10 years to save up $50,000. I was like, holy crap, like maybe there's something to this real estate thing. So at that point, I essentially decided to YOLO, and I HELOC my one bedroom condo, and I used that as a war chest to start house hacking some 3 or 4 units in Worcester, Massachusetts, buying commercial property, running out of my own cash and figuring out how to raise money from investors. And here I am today, 4 years later at 400 doors.
Okay, so let's just slow down for a second. So you have a condo, you're taking a HELOC, that's a home equity loan or a line of credit, and you're using that to buy another property or a down payment for another property?
That's exactly correct. So at that point, I believe I went to Citizens Bank. They gave me an 85% line of credit. So I had some equity in there. They gave me a line of credit for about $200,000. And it was right during COVID. So I think the rate on there was like 3%. My thought process, and I don't know, this was my thought process, like I'm borrowing at a 3. If I can find investments that pay me higher than a 3, like I'm going to win out. I'm going to use this concept of arbitrage to build my net worth, right? So I've been like, okay, so my thesis was I'm going to take this through, I'm going to borrow it at through, I'm going to put in these real estate assets, providing me a 10 to 50% return. I'm going to collect the delta. And that was my thesis going into real estate.
Got it. Okay. And when you purchased your first property, you're buying your first property is the condo, you're living in it.
Yep.
You're tapping into the equity, you're buying another property. What kind of properties are you buying? And are you flipping? Are you selling? You're rehabbing? You're doing tons of work? What are you doing with these next purchases?
So I am primarily buying value add multifamily, buy and hold multifamily. So these are multifamily in Worcester, Massachusetts, which thankfully it's honestly the mecca for multifamily. 30 to 40% of the housing stock is multifamily. And for my first deal, I obviously bought a turnkey asset. I bought a low risk asset. But the idea behind what I'm doing out here is more or less I'm buying these value add multifamily, 20 to 30% discount on a price per unit basis with 40 to 50% depressed rents, right? I'm going in there, I'm increasing the rents, getting them up to market, and then essentially doing a cash out refi or potentially 1031. I'm using velocity of capital, suck up that equity to buy more and more property. That's how I've been able to scale so quickly is I'm stabilizing these assets quickly, doing cash out refis, buying more assets, stabilizing the asset quickly, doing cash out refis, buying more assets.
When you're doing a cash out refi, what's the typical LTV loans that you're getting?
Typically, I'm getting between 75 to 80% LTV in Massachusetts. And the one gripe I have with the investing community, and don't get me wrong, I love everybody here, right? But everybody craps on Massachusetts as a market to invest in. I think everybody is freaking crazy. I think Massachusetts is absolutely one of the best markets to invest in. And one of the main reasons for that is the competitive landscape. There is over 300 small local credit unions and banks, right? So as a result, like you get really competitive terms. Like I buy properties at 75% of the purchase price, 100% of the construction at 6.5% from these small local credit unions all the freaking time. But combined with that, vacancies are very low. Growth rate is high. It's very hard to build. So the pre-existing construction is extremely easy to rent. For a multitude, I love Massachusetts, and I think it's a great place to invest in.
You actually brought up a good point that I never thought of before. At first, when you were starting to say that Massachusetts is a great state to invest, I was inclined to agree, thinking New York City is also, if you know how to do it, and LA as well. I had a guy on here who's developing and buying and doing very well in Los Angeles. But then you mentioned that one of the reasons that Massachusetts was so great was because of the overabundance of credit unions. And I know local banks, their charter is to lend locally. And for the most part, they are doing tons of local mortgages. Chase Bank and Bank of America, these guys have tons of 100 million credit cards out there, and Wall Street guys, they don't have to do so many loans. But a bank or a credit union with like 10 branches or less, they have to do loans.
Totally.
And are you saying that you're able to get better financing being in an area that just has an overabundance of lenders? I never even thought of it that way.
That's exactly correct. That's exactly what I'm doing. And on top of that, to your point, these credit unions have things in their charter. One thing in their charter is they can't do prepays, right? So I can go to these credit unions, I can buy a value add deal. They can give me essentially all the construction money, and then I can just refi it out and I don't have to pay any prepay. It's better than hard money. And it's literally, the rates are like in the sixes, right? Wow. So it's like, I can do deep value at them, some of these commercial multis at extremely competitive debt rates.
You mentioned before that you read a book, Rich Dad, Poor Dad. I know I made a joke about it in the beginning, but tell me what specifically about that book that really got you into this game.
I think the main thing that really, there was so many great concepts in there. Obviously, it's about accumulating assets and not liabilities and realizing what an asset is versus what a liability. That was absolutely huge. I think the whole thing was the mindset, right? In Rich Dad, Poor Dad, it's not about making excuses. It's about have some self-sufficiency and always finding an answer, right? There's a way that it kind of pushes you to have the entrepreneurial spirit to always get the job done. And that's what really stuck with me with Rich Dad, Poor Dad. Obviously, all the other great points, but that thread really stuck with me.
So I have my own Rich Dad, Poor Dad story. So I never read the book till I was in real estate for 5 or 6 years. However, I was tremendously influenced by him way before. When I was a kid in the 90s, I didn't have cable TV at home or it wasn't as common. There used to be something called infomercials. I might be too young for that, but basically after 1 a.m. on channels, they ran out of programming and they would show these 45-minute commercials. And it
Oh
would
my
be
God.
people
Yeah.
selling blenders, jewelry, a computer, and tons of like self help
Mhm.
and all that stuff. And it was when Rich Dad Poor Dad, the book, was launched. And they had these rotating 45-minute commercials with him selling the book. Again, it wasn't a big hit at the time, or it was brand new. It was, maybe that's why it became so big. But he was basically sold and spoke about the different concepts in the book for 45 minutes straight. And he had 3 or 4 of these rotating over the couple of years. And I used to watch these and I would learn every concept about the neighbor whose father was considered the rich dad, even though he didn't have a job. And my father has a job. He's the poor dad. It really stuck with me. W-2 income versus investment income. And I got into real estate because of those infomercials. So I didn't read the book. I didn't splurge on as a kid. So I didn't order the book. It wasn't a credit card like you have now. Every kid has one. But I watched these and I learned so much from them. So that's my Robert Kiyosaki.
Yeah, to your point, I think the best way to describe it is an epiphany, right? Like you just realize that everything you learned in the school system about money and finance is absolutely wrong, and this is the truth.
Yeah, yeah, it's so amazing. Like you said, it's an epiphany. It really changed the way I look at money.
Same here.
Yeah. Let me ask you this. You went from 1 unit to close to 400 units or 400 units plus. And how'd you scale so fast? Are you buying it? Are you self-managing it? Do you
Mm,
work with great third-party operators, vertically integrated? Give me
mm.
some details on this.
Sure. So I am vertically integrated. So Freedom Management also self-manages a majority of those doors, and I have about 20 employees that work underneath me. That help manage them, that help with managing my investors. So the way I scaled so quickly, essentially I got up to 30 units by myself, leveraging my HELOC that I mentioned through house hacks. When that ran out, I start leverage my 401k. I leveraged promissory notes. And at that point, I ran out of all this cash, but I was getting all these great deals coming my way. Like at that point, I established the largest real estate meetup in Worcester. Like I had really great deal flow. And right at that very moment, I got on the Bigger Pockets rookie podcast. So I had all these great things going for me. And then somebody brought me a 65 unit portfolio and got this great deal, but I have no means of taking it down. So at that point, I thought I had the ability to raise the capital. I came to find out that I didn't, and I had to call my mentor last minute to save the day, which he did. But we raised about 1.1 million on my first capital raise, which I thought was pretty good. We had to raise about 1.8. And then at that point, once we had some momentum behind us, deals started coming our way, and we were able to just raise for a lot of these deals and do a lot of joint ventures and do, syndications. And more or less, I probably have about 70 to 80 partners across all of my deals.
These properties that you're self-managing, these are all local. How far is the distance from like furthest to?
So they're all within an hour of me. So I own a couple hundred in Worcester, Massachusetts, which is my home base. I own 50 to 60 in Woonsocket, Rhode Island, which is probably 30 to 45 minutes away from Worcester. I probably own 30 to 40 in Lowell, which is 30 minutes north of Worcester. I own 50 in New Bedford. That's a third party manager, about an hour and a half. So most of my units are local. And honestly, that's our competitive advantage is we're vertically integrated. And honestly, when it comes to value add multifamily and multifamily in general, the money is made in the operations, right? Like our vacancies probably down to 3-4%, our collections 95%. You have to run these things with a fine tooth. You have to run them extremely efficiently to really make money off these things.
So you're hiring good people, obviously.
Yep.
What does your typical day look like? Like the average 9 to 5? I know I say 9 to 5 very facetiously. I know it's almost like a 24-hour type of grind. You see an email at 2
Sure.
a.m., you're inclined to at least be thinking about it, whether you're responding or not. What's your typical day? Are you sitting in an office all day? Are you looking at the boilers, shelf life? What's your typical day?
Early on in our development, we did hire a consultant and he really helped us intentionally build our organization. So we utilized a framework called the Cultural Index, which is a personality type test. And that really allows us to get good talent and put them in the right seat And we have started implementing EOS, the entrepreneur organization system that allows you to essentially how it allows you to do vision planning for your entire organization and distill that down to the individual level via KPI. We've been very intentional about the way we build our organization, and I more sit as the CEO, as the visionary in the organization. And my partner, Zach Gray, my 50-50 partner, he's very much the integrator. So what my day looks like, say on Monday, we have our all team meeting where we go over every single property, the vacancy, the bank balance, the delinquency, any open work orders. What can we do to fill the vacancy? We go through every single project and get my team on the same page. But at that point, I might have a call with a lender, an investor, be on a podcast, walk a property that we have under contract and help and create the rental budget with my partner Zach, underwrite a property, ensure we get our loan request packages out, appraisal packages, manage aspects of the disposition. More or less, I'm not really managing the day-to-day. I'm managing growth activities. I'm managing acquisitions. I'm managing dispositions. I'm managing ways we can grow our business long-term. So that's a day in my life. But yeah,
You ever use any creative financing in any of your deals?
I have used some creative financing. We closed on how many units was that? We closed on 21 units in Lawrence, Massachusetts, where the seller gave us a $800K note for the down payment. So we only had to bring 2 or 300K, which we 1031 another underperforming 6-unit in Worcester so we essentially traded a 6-unit for a 24-unit in Lawrence, Massachusetts, a $1 million asset to a $3.4 million asset. That was one way we did that. We've also had, like you said, the seller hold back a second lien, so we bring less money down. We did that on 6 units in Charlton, Massachusetts. The seller held a 10% note, allowing us to only bring 15% down. So we've done things like that. But in regards to a full seller finance buy, we have not done that.
When, just for example, these two deals that you mentioned where the seller held back, helped you out with some down payment money.
Sure.
Was that advertised or marketed upfront? Was that something after going back and forth, maybe you couldn't come to an agreement or a good structure where either you made the ask or he made the offer or the broker came up with it? Like, how did it come to play?
The way it really came to play was they wanted more money. They wanted the price and our numbers didn't make sense. So it's give us this term to make it make sense for us. Like that pretty much happened in both of those opportunities. Like the property I paid 3.4 for in Lawrence, I think pro forma rent was 40 grand, 42 grand. So it makes sense, but we offered 3 million and we're like, all right, we'll give you 3.4 if you hold back an 800K note. So we gave them the price they wanted it, but we had to bring very little money down for that property. Those were the situations where it made sense for us.
One of the biggest criteria I have when someone sends me a property, one of the first questions I have is how long do they own the property? Now, if somebody owns it for a year or two, and this is maybe typically more in the larger multifamily, but if they only own it for a year or two, I feel that there's less wiggle room when it comes to a potential creative financing or a creative structure. I find that when they own it for 10, 12 years plus, I guess it's because they have so much equity in there or their base is so much lower that they could afford to, I'll take a higher price and wait an extra year or two for part of my money. They see the tax benefits of the seller financing instead of taking all their profits up front. In 1 year, they could split it out over a couple of years. But yeah, one of my big questions, if somebody sends me a property and the email and the subject says owned by the same guy for 15 years, I'm instantly opening that because that to me means this guy could have so much flexibility to be creative. And I really love creative financing. It's really helped me out in the past. It helps me out even in the multifamily. I've done creative structures for millions of dollars. And it's such a boom. It's such a great tool to use when it comes to structuring a deal.
Yeah, I mean, you're so right. Equity creates options, right? And I totally agree with you. And I definitely can learn a lot from you and on the best practices for seller financing. Thankfully, like I have such great like debt terms out here that a lot of times I can make it work with just bank financing, but I would love to learn more strategies along those lines.
Where do you see yourself with the business in 5 years?
So I see a self-sufficient business that's growing on its own without my intervention. And I probably work 5 to 10 hours in a week. I'm traveling the world, probably 6 months out of the year. I have a family, and I'm helping other people reach financial independence. That's where I see myself in 5 years. And I'm not that far off, but yeah, yeah. It's been a fun journey the last 4 years. It definitely has.
What do you do for fun?
So I love hiking.
Okay.
I love traveling. I've been to Italy 3 times this year. I go to a lot of conferences. I went to a Tony Robbins event. I love self-development. I go to a lot of GoBundance events, which is a mastermind group I'm a part of. I enjoy working out. I'm a big workout kick. I think since December, I've lost like 30 pounds.
Oh, wow. Okay.
So yeah, so I got a really good coach there. Yeah, I just loved growing myself into a better version every day. I think the meaning of life is growth, because when you stop growing, what happens? You wither away. And I just want to keep growing and being better every day.
Any dream travel spot that you haven't been to yet?
Tokyo. Absolutely want to visit Tokyo. I'm very intrigued by the culture, the anime, the manga, the sushi, the food culture. There's so many aspects of the Japanese culture which I love. I can't wait to visit Tokyo.
Any big mistakes you made in real estate that you want to, in hindsight, you could talk about without breaking into hives?
Yeah, I would say one of the mistakes that I would have avoided is shiny object syndrome, right? I'm really good at value add multifamily. I'm fantastic at stabilizing these underperforming assets and getting them performing, kicking out cash flow. I'm less good at flipping. And I think in the beginning of the year, I did take a lot of flips. Like, we're exiting them. Like, most of them are making money. Maybe some I'm losing 10, 20K here. But the issue is it's just taking my attention away from what I'm really good at, which is buying value add multifamily. So I just need to get back to the basics and just stick with kind of what I'm a genius in.
I happen not to like the flipping business. I never did, ever.
Mhm.
It's very taxable. And every month or every day that you're holding it longer than you want to is like really costing money.
And it's a job. It's a
Correct.
job, right? And then when I stabilize an asset, it takes very little time to manage it, right? But like, these flips require so much oversight that it's just, I think my flips probably take a good day and a half away from my weekly work, which I could spend that toward buying hundreds of more units. So
It takes away, for me, it takes away like headspace on my
yeah,
mind.
exactly.
It's really, yeah.
Totally. Exactly. And like you said, the longer you have the note, the less your profit goes down.
Exactly. Exactly. Best piece of advice you got from a mentor? You mentioned you had a mentor. What's a good piece of advice he gave you?
I would say be conscientious of the concept of modeling, right? If you want to be exceptional in anything, all you really have to do is find somebody who's exceptional in that thing and model them. I did that with buying hundreds and hundreds of units. I got a mentor who owned hundreds and hundreds of units, and I saw what he did on a daily basis, and I'm emulated him, right? It's the same with anything in life, right? If you really want to get great at something, find a way to provide somebody who you want to model immense value, expecting nothing in return. And at a certain point, the concept of reciprocity will kick in. They are going to want to help you, and then you should just be a sponge at that point. If you want success, that is the easiest way to success.
Today is August 27th, 2025. If you had a crystal ball, are rates going to go down in 12 months from now? Meaning within 12 months from now, will rates be down?
If I had a crystal ball, I would say no. The reason why I would say no is because, based off my experience in this world, if the prediction is things are going to go left, it's going to go right. That's the fact of the matter, right? If the consensus is rates are going to go down, I believe the opposite. I don't know, maybe I'm a contrarian thinker, but either way, I'm underwriting all my properties where the rates are staying consistent. I'm not making assumptions that rates are going down in any near future.
So a couple of years ago, I took a bridge loan at the exact worst time. And thank God I was able to get out of it. But I took a bridge loan where at the time of closing, my payment was around 5% interest rate. And by the time I got out of it, it was pushing 11. It wasn't 11, but pushing 11. The question is today, would I take that same loan, and assuming, I don't know if it would be 11, it might be 7 or 8. Would I still take that loan today for fear of it going back up? Or could I be confident that it's going to go down? The bridge loan is typically 2 years, 3 years.
I would take that loan all day if there's enough equity.
Yeah.
If you're buying at 50% of the value, even if values drop 10, 20%, you're still in the green. Right. So I'm taking out a 100% loan on a 5 unit right now. I only had to bring $7,200 to close. That's 12%, 2 points. But we got this thing at 525. It needs $200K worth of work, and the thing's got to be worth 1.1. Like, even if the values went down by 20%, I can still sell that and make $100,000.
When I took that bridge loan I mentioned, we were at 5%. And I think for our pro forma, we underwrote conservatively that it may go up to 8%. And even when we're doing 8%, we're lasting like 8%. And when it hit 8% plus, it really hurt us. It really hurt us. Our only saving grace was that, when I say saving grace, that I didn't have to do a capital call in order to refinance out, was because right before the closing of this original loan, the fund decided to lower their LTV. Originally, it was at, I think, at 70. And then like at the last minute, they lowered it to 67 point something. And they said it's within their metrics. They need it. It has to be. They're funded by some insurance company, whatever it was. And at the time we were pissed and we had to raise extra money, but it ended up saving us because when we got out of the loan, we only had to replace now a smaller balance effectively. And a lot of my peers in my shoes at that time were stuck in these loans and they couldn't get out because they couldn't afford to bring money to the table on a refinance. And they were avoiding a cash call and they're just holding on to it. And some of them are riding it out and some are no longer on the horse.
So let me ask you this: that asset you referred to, was it a bigger asset? Was it a smaller asset? Like what's it look like?
Sure.
The reason why I'm asking is because larger assets are like a large boat. They bring a lot of force, but they're very slow to turn. Versus the smaller assets, they're like more like an agile boat. They can move quicker. So I'm just curious, like what kind of asset that was.
Sure. So this was 180 units and the loan was about $8 million.
Okay. Yeah. So I'm talking about a 5 unit, like 5, 6, 7 unit. So it's like I can get in and out of that thing in like 6 months.
Because worst comes to worst, you can just somehow pay it off or figure out how to pay it off. Or it's just the percent is crazy, but the actual dollar amount is not too absurd.
Correct. But to your point, would I take that loan out on a 190 unit portfolio right now? No. I think I just want to put that in context.
Got it. Yeah. I'm just always curious what people think about rates.
Yeah.
I'll tell you, for the last 3 years, I keep saying that within 6 months, I think it'll be lower. So we'll see what happens. My take is I'm optimistic it's not going to get raised. But I am optimistic that sometime in the next 2 or 3 years, it'll get lowered. I know the president is trying to get it done. I think if he claps hard enough, somehow or another.
It's definitely going to happen with Donald Trump. There's no ifs, ands, or buts, right? The guy gets what the guy wants, lower rates, right? But sure. I'm not gonna bet on that. I'm just gonna play with the cards I have, and if I get dealt a better hand, it's what it is.
Andrew, I had a great time talking to you. I spoke with you off camera. I spoke with you on camera. A lot of fun to talk to you. I follow you on LinkedIn. You're putting out some great content. So I really enjoy that. You're having great success in what you're doing. And tell our audience, exactly how they can reach you, or if they want to do anything with you. Put your LinkedIn, phone number, email. You could say it. I could put it in the notes. We could do both. Just tell everybody.
Sure. It's Andrew Freed. You could find me on Facebook or LinkedIn, or you could find me on Instagram at Investor Freed. I buy value add multifamily in Worcester and New England. I'm starting to raise a fund for that, the Path to Freedom Fund. So if you're interested in that sort of asset, definitely feel free to connect with me. But otherwise, it's been an absolute blast, Steve. You're a wealth of knowledge, and I'm definitely going to stay in touch off camera because I definitely have a lot of questions to ask you.
Okay, great. I'm going to put some contact info, some of your links in the show notes. Andrew, thank you very much for joining us. It was a real privilege to have you on my podcast, the Wealth Flock podcast with Stephen Weinstock. I appreciate the insights that you shared using velocity in order to scale, taking that capital and really speeding it up. I like how you verbalized that. So that was pretty good. You've been featured on Bigger Pockets. Now you've been featured on my podcast. It's been a real honor. Everyone else listening, if you enjoyed it, please subscribe, share it, tag it on social media. Andrew, thank you very much for joining me, and I will see you.
It's been a privilege. Thank you.